welcome to this week's edition of MFB News. I hope you're all really well. I hope you had a really beautiful bank holiday weekend. Weather was not bad at all, was it? I survived Scotland just. We got there and caught the tail end of a hurricane, so it was absolutely lashing it down with rain. The winds were hurling around. It was quite incredible, but once the clouds actually dissipated, what an amazing place. Absolutely beautiful. I'd really recommend it for those of you who haven't been. Really stunning. Now, enough about my holidays. Let's talk about what we're going to be covering off this week. So first up, we're going to do our usual update on what's been happening with mortgage interest rates and swap rates. We're then going to touch on the speculation that's currently sitting around the autumn budget, in particular capital gains tax, and let you know what some of our landlords are saying in terms of response to any potential negative changes that come in there. We're going to talk about very briefly retail prices and deflation, and then finally we're going to be just giving you some updated data in terms of rental yields. Okay, so first up, interest rates and swap rates in particular. Now, I was having a conversation with one of my most favourite clients, really charming gentleman, and we were just discussing the video, and they gave me a piece of feedback which is actually really valid. And actually, incidentally, if any of you do have any feedback on this video, things you'd like to include, exclude, that kind of stuff, please just let us know. The whole point of this video is to kind of give you information. So if we're not quite touching all the right points, then we'd love to know so we can kind of improve things. But aside from that, what they were saying is that actually, when we're giving out the swap rates, when I sort of go 3.815, actually the 15 at the end is too much information. It kind of gets lost. So 3.8 would just do the job perfectly well. So what I'm going to attempt to do to try and make the data more kind of palatable is round up or down the numbers for you this week. So let's see how we go. This might take a bit of practice over the next few weeks, but I'm sure I'll nail it in the end. Okay, so first of all, 2-year swap rates are currently at 4.03%. 1 month ago 4.3 and 1 year ago 5.5. So again, year on year, step down, month on month, smaller step down, but actually week on week, no real changes. Very similar story for your 5-year swap rates. So 3.64 as of last night, 1 month ago 3.8 and 1 year ago 4.8%. So you can see again, same direction of travel as the 2-year rate. So what does this actually mean? So the first thing is that actually a week of no big changes is a good week as far as I'm concerned, because what we don't like is a lot of volatility, because that shows there's a lot of concern and nervousness in the market. So that's a real positive. What it also means is that lenders' cost of funds hasn't changed in the last week. So if we are seeing lenders in the week going forwards dropping interest rates, it's not because their cost of funds has changed. It's because they're making a decision based on two things. Either, first of all, they haven't actually made changes more recently, so they still have the ability to step down and catch up with everybody else, basically. The second thing may be that actually they're looking at their business volumes, their new lending volumes, they're saying actually we'd really like to try and drive things up a little bit. So actually if we take a hit on our profit, our margin, to try and bring down the interest rates, this would mean that actually we might get some more business in. So I think really, unless we see any notable changes in swap rates over the next week, things are going to be relatively quiet. Having said that, there has been a fair amount of movement on pricing in the last week. So what have we seen? So we've seen Fleet make reductions of up to 0.35% on HMO rates only. Now, it's worth just saying here and kind of echoing back to what I've just said, Fleet have repriced, but they hadn't repriced their HMO rates. So this is a kind of catch-up situation. Shawbrook down by 0.3. Now, Shawbrook haven't repriced in quite a while. Now, for Shawbrook, for those of you who aren't familiar with them, they are what we called, I mean, this is sort of terminology going back to sort of after the credit crisis, a challenger bank. So Shawbrook were really born after the credit crisis. They have been around for a really long time, and they are a commercial lender. That's how they started off, who can they try and cover all types of landlord lending, or investment lending is probably a better description there. Excuse me. So what I mean by this is that they can lend on very standard properties. They can lend on more complex residential properties, so your larger HMOs and multi-units. There's no limit on the number of rooms or units here. Semi-commercial, so for example, a shop with a flat above. Full commercial investment, commercial owner occupier as well. They also do bridging finance, and their bridging is really good, very competitively priced. So they're kind of lending on all types of investment finance, which is really, really good. And so by dropping their rates down by 0.3, and my understanding this is across the whole board, that's really encouraging. Now we've seen Kensington bring their rates down by 0.3, Molo by 0.2, HSBC by 0.3, Leeds by 0.2, Accord by 0.2, and NatWest by 0.15%. So we have seen some real movement there, but probably not quite to the same extent that we've seen in previous weeks. Now there's been a couple of other bits of news just to kind of run through. So first of all, Paragon, they haven't reduced their rates, but they brought out some new rates. Excuse me. 2-year fixed rate specifically, and the reason I like these is because there is no arrangement fee and a free valuation. And what we need to keep in mind is the kind of lender that Paragon is. So they're a specialist lender, no maximum number of properties in the background. If you're a portfolio landlord, no minimum income, HMOs of up to 20 rooms, multi-units of up to 20 self-contained units. They can lend on some pretty lumpy assets. In addition, limited company lending, they can do layered companies, all that kind of stuff. So they're a real specialist lender. And they've got a 2-year fixed rate now, which for standard self-contained properties, single self-contained properties, from 6.1, and for HMOs from 6.35%, which with no arrangement fee and a free valuation actually really does offer very good value in the marketplace. And the reason I think people will be interested in this is a lot of borrowers we're talking to are saying that I really want to take a 2-year fixed rate because I'm still convinced that the rate of travel, direction of travel for interest rates is downwards, and I'll be inclined to agree with them. But what I don't want to do is spend massive amounts of fees setting this up. It's almost like this is a sticking plaster to tide me over for the next couple of years. Then I'll come back to this and kind of put something a bit more long term in. And if I'm going to do a 5-year fix, I don't mind paying larger fees. But for now, I just want something to kind of get off a variable rate, essentially. So this is a really great solution for that, as far as I'm concerned. 2 other things have happened in the last week. First of all, Landbay have reintroduced AVMs. So they have a specific set of products available where they don't actually need to physically visit the property. The valuer does a remote valuation by looking on Zoopla and registering, that kind of stuff, and Street View, and then they form an opinion of what the property's worth and they value it that way. Landbay are one of the very few lenders who have a specific set of products where you can have an AVM. Most lenders, or some lenders rather, would accept AVMs, but they only offer these on certain types of properties. And they don't share with us the sort of entry criteria to be eligible for an AVM, because I'm being quite cynical here. If brokers were aware of all these entry points, they probably sort of to some extent abuse it. They prefer to keep that to themselves, which is absolutely understandable. But Landbay are one of those lenders who say, look, actually, we have a dedicated set of products. If you want an AVM, here's our product set. There is still entry criteria, so they're not for everybody, but actually really great to see them come back into that space after kind of moving out of it for a few months there. And the last one this week is an interesting one. So Foundation Home Loans, who again have been around for, I don't know, 10 years or something, a really long time. They have now started accepting consumer buy-to-lets, which they previously hadn't. Now, consumer buy-to-let is essentially a buy-to-let mortgage where the objective of acquiring the property, it was not for investment purposes. So by that, I would mean that you are going to rent out the house in which you're currently living. So you bought it with the aim of living in it. Now you want to rent it out. That could be consumer buy-to-let. Actually, a lot of lenders make exceptions for this if you're already a landlord. But if you were, this was going to be your first rental property, you would fall into consumer. Another example would be that you inherited a property. You didn't inherit it with a view of renting out. You inherited it just because you inherited it. So that would be consumer as well. Now, a lot of lenders do consumer buy-to-lets, but not all of them. And this is because of the kind of regulatory requirements that sit around consumer lending. So if a mortgage is a consumer buy-to-let, you have various kind of protections from the FCA, and therefore some lenders just simply don't offer it. So it's been really great to see Foundation move into that market. So in summary, while there's not been a huge amount of change on swap rates, actually there's been a fair amount of movement with the lenders. And I think as we move into September, while, as I mentioned earlier on, there's no kind of obvious reason for rates to come down any further unless lenders are doing it by, sort of their own sort of willingness to take a hit on their margins. What I do think we're going to be seeing is a bit of jostling because it is kind of back to work after the summer break. So as always, we will keep you posted. Okay, now as landlords, we've always got something to worry about, and the thing that seems to be top of the list of concerns for many landlords at the moment when we're talking to them is the autumn statement. Now, people have been speculating about some of the changes that may be coming in, and the removal of, or the increase, in capital gains tax is certainly one that people are expecting to come in. Now, Keir Starmer yesterday did a speech from the Rose Garden, which was very nice, in number 10 Downing Street. And he made reference to the fact that this budget is going to be really, really painful, and actually those who have the broadest shoulders should carry the hardest burden. So essentially what he's saying is, brace yourselves guys, it's going to be ugly. As this has really set media into kind of a massive frenzy in terms of what that actually means. And just to kind of cover off capital gains tax for a moment, so capital gains tax is essentially imposed on the profit from the sale of capital assets, including investment or second homes, shares, business assets and most personal possessions which are worth more than £6,000, with the exclusion here being cars. Now currently you don't have to pay tax on the first £3,000 worth of profit or £1,500 if it's from a trust. Now this minimum limit could be removed and tax imposed on those assets which are exempt. So that's kind of the first kind of possibility here. Now the second thing is that there's also been speculation about increases to the capital gains tax rates. So it could be that they decide to bring them in line with the current higher rate of income tax, which is at 40%. Now, a higher rate of capital gains tax was already applied to the disposal of residential properties since 2016. For some years it was 28%, but then it dropped to 24% at the end of the Conservative government. So essentially for those landlords who have properties which, they're thinking about selling, this has thrown them into a real quandary. And there are a lot of landlords who have been thinking about selling for a while. They've been waiting for house prices to kind of settle and then they're going to get the house on the market. Now there's this kind of concern about the autumn statement. And some of our landlords are saying the real quandary for me is, should I wait and see what happens? Or is it that actually any change in taxation will be brought in on the day, or will it be that actually it comes in April? No one really knows what the timing here is going to be. And whilst the property market is certainly starting to recover, it's by no means running hot. So actually selling a property, getting a property sold between the end of August and the end of October would be a bit of a stretch. So one of the things that we've been seeing from some of our clients is that this has kind of renewed their decision to incorporate their portfolio. So when you sell a property which is owned by a limited company, you don't pay capital gains tax. What actually happens is it forms part of the company's profit, and then you pay corporation tax, which is lower than the 40% or 24% as it currently is. So what we are seeing is some landlords are saying, actually, I've been thinking about, incorporating and actually maybe selling a couple of properties across to my limited company. Now, paying the capital gains tax as it stands right now is going to be better than kind of panicking later and selling. Also, obviously, if you were to move across to a limited company, sell across to a limited company now, you would also enjoy the favourable sort of taxation, which kind of flies in the face of Section 24 anyway. So that's the kind of latest on the capital gains tax. And I think really we're just going to have to kind of watch this space. But I think the key thing to kind of understand here is that lots of landlords have been talking about selling, but actually lots of landlords haven't even actually sold. This is another thing that's going to kind of help maybe focus their decisions to make good on that sort of plan. But actually most of the landlords we're talking to are saying, I don't really want to sell, having thought about it and gone through the last couple of years, which has been the really painful bit. I don't actually want to sell my buy-to-let. I'm now going to hang on to it. And I'm recommitted to being in the market. So actually, how can I position myself, get things set up so that any change in capital gains tax is as less painful as it possibly can be. Okay, now here's a word I didn't think I'd be saying, deflation. So prices in UK shops has fallen for the first time in almost 3 years, driven by heavy markdowns as clothing retailers attempt to sell off summer stock. And this has all been linked to kind of the, people are saying atrocious weather. I actually think the summer's been really nice, but apparently it's all about the weather. So new data showed prices were down by 0.3% in the first week of August compared to the same period last year. That compares to a 0.2% rise in July and a 3-month average of 0%. Now, I think the reason I wanted to share this with you is that when you get something like this happening, there is a bit of deflation going on. Immediately, everyone gets really, really excited. This is really only applying to a very specific sector, which is largely retail, particularly clothing. So I don't think we're going to see a massive deflation in terms of food prices and that kind of stuff. And therefore, what I'm not expecting is to see inflation in the round start to really fall. So just to kind of recap, the expectation is that because of the change in energy prices, actually inflation is going to increase, and everyone's kind of predicting this, up to between sort of 2.7, 2.9% for the rest of this year, and then it will come back down again as we move into 2025. But I think really what I suppose the message I wanted to give with you is if you see a headline about deflation, immediately people's minds go, amazing, deflation. That means inflation is going to kind of go negative, which means that actually interest rates can come down even further, and that means the base rate's going to come down really, really quick. I can't see that happening because, like I say, the deflation only applies to a very specific part of, you know, a very large economic market. And that means that actually in the round, there's kind of actually reasons why inflation is going to be increasing. Nothing to worry about. It's been priced in. People are expecting it as long as it doesn't kind of go crazy. But that's why I don't think we're going to see a big rush on interest rates coming down further based on the headlines you will see about deflation. Okay, and then finally, this one is hot off the press. So Knight Frank has set out its forecast for the rental sector for the rest of 24, notwithstanding uncertainty over rental reform. So in the mainstream UK market, annual growth was 8.6% in July and falling, which means it should end the year close to Knight Frank's 6% forecast. So essentially the growth in rents is still growing, but it's slowing down now. So down to sort of 6% by the end of this year, if Knight Frank are right. In prime central London, the agency forecast growth will fall to 2% this year as supply increases from the lows of the pandemic. The increase was 0.9% in the 6 months to June. Meanwhile, rental values in prime outer London increased 0.7% in the 6 months to June. The agency's forecast is 2.5% for the whole year. Now that kind of, I guess really what I read in that is London and outer London, central and outer London are kind of showing really much lower rental growth than other parts of the UK, because if the average is 8.6% and, you know, central London is, you know, 0.9%, then that actually just shows the real disparity there. Knight Frank says it will reassess the numbers once it knows more about the government's plans for the letting industry. For now, it says only two things are certain. First, the Labour government will introduce their own version of the Conservative Party's Renters Reform Bill during this Parliament. Second, it's been talking tougher on landlords. Measures could include making it harder to evict tenants and tighter rules around green credentials for letting properties. Meanwhile, capital gains tax could also rise in October's budget, and we know all about that now. If enough landlords sell because the new rules are too financially punitive, it will increase upwards pressure on rents. We therefore expect the next 3 months to provide more clarity about the longer-term future for the UK housing market than the last 3. So I think the message there is, I feel like I say this all the time, let's wait and see. But actually, I think the reality is that in terms of rental yields, and given the direction of travel of where things are going with Labour and their kind of treatment is probably a too negative word, but the way they're kind of looking to act with landlords, the reality is that there's going to be more landlords divesting, which means there's going to be less rental stock, which will put more pressure on the market, and therefore that will continue to support rental rents increasing, so yields increasing as we move into the next few years. Wow, what a busy update for you this week. Who says August is a quiet month in the world of mortgages? But I hope you found that helpful. And as always, if you have any questions, do give us a shout, 0345 345 6788. I believe that when I speak to you this time next week, the kids will be back at school. So yeah, that will be nice. So look, have a super week, have a super weekend. Enjoy the last knockings of summer. It's starting to feel autumny. Is that even a word? It's starting to feel like autumn now. You can sort of see that things are starting to come to an end. So it's time to start getting ready for Christmas. And on that note, I'll see you next week.